Hello, everyone, and welcome to another episode of Idiot Investor. I am your host, Justin Alexander, and got some exciting news on my end. I got a real mic, so I should start sounding better, have less clipping in and out, and overall should be a better show. So I'm excited to get into this one. I want to do a continuation of how to start investing. And so, we know the basics. We need to pay off debt, okay, because that's money that's just coming out, and especially if you're paying interest, mainly if you're paying interest. There's good debt, bad debt. Your house is like good debt because that's gaining equity, but like a car, for example, would not be good debt. Unless, everybody needs a car, but you know what I mean. It's not good to buy a overly expensive car and have to pay interest on that, so pay interest. No, don't pay interest. You should contribute. If you have a 401k and they match, you should be maxing that out to the contribute point, because that's free money. And then you should start to contribute to your Roth IRA. There's $6,000 a year is the max. That ends up being $500 a month. Pretty doable, and the Roth is great because it's allowed to grow and grow and grow. And then when you're 65, you can take it out without any tax penalty. At that point, if you want to be extra, you can put money into a health savings account or a 529 plan. And basically those they're kind of like an IRA, but it's meant to be used on healthcare or colleges for your child, or you can give it to anyone, I believe, with a 529. That's that. And then, you have your Roth IRA, you opened your account, and now you need to know what to buy. And often I will look at ETFs, look at like the top holdings. Let's say, let's just look at VU for now. VU is the S&P 500. This is what I suggest people buy into to start. This will help you understand how to buy a share of something, how to sell, what a market and a limit order means. And just, it's a safe investment, relatively safe. Okay. Top holdings, top 10 are Apple. These are the largest companies in America, specifically America, but they do business obviously around the world. But Apple, Microsoft, Amazon, Facebook, Google, or Alphabet, Tesla, Berkshire Hathaway, JP Morgan, and Johnson & Johnson. So the left side is more growth. The right side is more value other than Tesla and Google. And that's kind of the balance of VU. That's why it's great. It has, right now, it has expensive growth stocks, but it has, relatively low value stocks. So it's a good balance. And again, most people do not outperform the S&P 500, even active managers and smart money. So, so if you say you wanted to know, well, what's more growth? Let's look at the growth ETF. And oftentimes, you could buy the ETF, or you could buy maybe the top holding in that ETF. And there's there's an expense to ETFs. There's a 0.04, which is very low. So that gets taken out daily. So what you see is what you get. So with VUG, for example, that's the growth ETF, up 73% this year and 150 over 5 years versus 100% for the S&P 500. And value is up 62. So VU is right in the middle. It's like a combination of the two. So if we look at the growth ETF, the holdings are going to look a lot like VU, but it's more tech heavy and consumer discretionary. And remember, these are growth companies growing fast. It's earnings, sales, people's knowledge of them. Apple ends up being 10%, Microsoft another 10. So the top 10 holdings are almost 45% of the ETF. And these are all really strong companies, especially if you look at the recent past. So those are all good companies. I would hold all those except for maybe Tesla. Tesla's kind of outlier and fucking ridiculous market cap because it had a ridiculous run for the past year, up 555%, and 1,000 PE, price to earnings, and a 600 billion market cap. I mean, Visa is only 467. They were much older, more well established, do a lot more business than them, but you know, that's the kind of story on Tesla. Let's look at the value ETF, VTV. And these are more large, well established, old school, like Coke and IBM, Johnson & Johnson. It's different makeup. It's like financials and healthcare and industrials, not so much tech. Top one is JP Morgan. That's a bank. You know, they came out of the financial crisis doing all right. Berkshire Hathaway, Johnson & Johnson. So those three were all in VU. Those were in the top 10. Then there's Disney, United Health, Procter & Gamble, Bank of America, Intel, Comcast, Exxon. So these haven't been the best. Some of them have been good movers like Disney and Johnson & Johnson. But you know, there's Comcast and Intel hasn't been doing very well, Bank of America. So I think growth has been outperforming for the last 10 years. So people expect value to kind of take over. And you can see that in like the market sector. This breaks down by lots of different things, small cap, mid cap, breaks down global, different commodities like gold and silver and gas. And you can see over the last 5 years, growth has way outperformed value, and a reversion of the mean. People expect value to now outperform growth. But I'm still very hesitant on that. I still think growth is going to be growth. So don't be scared to get into those names, especially the higher quality like Apple and Amazon, you know, going far out on the risk spectrum and getting shitty, smaller tech, small cap companies. That's probably not going to end up well for you. I pretty much avoid small cap altogether, and I use like a small cap ETF to get exposure into that. And so the small cap ETF, for example, let's look at that. It's going to be completely different than VU. Or no, it's not VC, it's VB. That is the small cap. I usually go to Vanguard because they're really low expense ratios and they're popular for having those low expense ratios. Okay, good rating. And 0.05 expense ratio, it's really low. More financials and tech, so it's kind of a mix. It's more diversified because you can see top 10 holdings are only 5% of the weight. So it's very diversified. And the top ones are Plug Power, Generac. A lot of these I've never heard of. A lot of them are like Enphase and Plug. Those are clean energy stocks that have been on a really good run. So they've gained a lot of market cap, and now these ETFs are market cap weighted, which means the ones that do well and go up get pushed up more and have more of a weighting. So you can see those in iClean. Those are going to be some of the top holdings. The Clean Energy ETF, Plug Power and Enphase, and other stocks. And these are, a lot of them are overvalued, but people still I think clean energy is going to do well and be a good place to be. And I want to show you, like, for example, VCR is the Consumer Discretionary ETF. You'll see what kind of companies are in there, and this is a case where maybe instead of buying the ETF, you can buy the top holding, because the top holding is 22% with Amazon. So do you really need these other ones? Do you really need TJ Maxx and Booking and Lowe's? And it's performed very well, and probably mainly because Amazon is in there. But if we look at VCR, it's up 145, so about as much as like the growth ETF. And let's see what Amazon has done. Oops. 63% and 440%. So that's a lot of what's driving that ETF. So that tells you should probably have VCR in there. Maybe another good example would be like Ring. That's the gold miners ETF with inflation expecting to rise. Gold miners and gold typically does well. But now with Bitcoin, everybody's going to Bitcoin instead of gold. And this has a surprisingly high expense ratio, 0.39. I liked it to be under 0.1. That's what most of Vanguard is. But this is another case where Newmont is 22%, Barrick Gold is 16%, and Wheaton Precious Metals 7.8%. So I actually own all three of those top holdings instead of owning the ETF. It's 73%. So it doesn't make, well, I do own Ring as well because, the combination of all the smaller things really does help with the returns. The small ones move quicker, move a lot more, so it can help get more out. So let's see how that has performed. It performed really well for a while there, and now it's been selling off. It's only up 70%. It's been selling off since it got to its high in July and August. So, and gold and Ring kind of moves opposite of the dollar, UUP. At least it's supposed to, which is why so many people have been getting into Bitcoin, because it's kind of doing the opposite of, God, what a terrible chart. Yeah, that's why people are getting into Bitcoin. And I don't think it'll crash like it did before. I think it will crash, but it's not going to be as dramatic as it was before. And I think people are going to be buying the dip, including institutions. So I still haven't gotten in. I wish I did at a bunch of different points, but you just got to live with it. So these are some of my holdings. I don't use Robinhood. I use Schwab. So let's continue with some investment resources while we're here. We got things like Morningstar. This is a great resource. I actually got this through my library, Pikes Peak Library District. You put it in, you go to your library and try and find investment resource area and put in your information, and then you can look up stocks. Let's look up like Microsoft, and they have smart security analysts, and they talk to the businesses and figure out what their future cash flow and stuff like that is going to look like. They give you a fair value, which I've found it works pretty well. I mean, they're kind of accurate. They also tell you if they got like a wide moat, what kind of stewardship, if they have good forward dividend is important, 1%. This is their market cap, 1.8 trillion. Forward PE of 30, and you can kind of compare that to like the S&P 500. Though this one has a PE ratio of 38, which is kind of high. I think historically it's supposed to be like 20 or something. So that's why people say this stock market is overvalued, and it probably is, but they've also been giving out stimulus and printing money, and so that causes stocks to go up basically because money's less valuable, and people want to save their money basically by having it grow more than what's being destroyed. And good things to look at are like return on equity. And these are the good things to look up. You can look this up on Investopedia. They'll give you a good definition of what all that stuff means. With dividends, you want to have a payout ratio of less than like 70%. And that's 70% of their earnings. That means after everything they made, they give out a quarterly dividend, and they give, it's, 30%. Yeah, right now it's only 30. That's pretty low. That means they have more room to grow it. And you can see their previous dividends given out here. You need to own the stock by the X dividend date to get the dividend. You can't buy the day of. You have to own it the day before. You can sell the day of and still get that dividend, but you have to be in on the X div date, by the X div date. And then they paid out. And the dividend actually comes right out of the price of the stock. So Microsoft, they pay like a 51-cent dividend a quarter. And the day that it goes X dividend, it will open up 52 cents lower. And that obviously varies because people are buying and selling after hours. So you might not even notice it the day of. It might actually be up the day of because people trade. So over time, if it's a good company and they're growing, and that's not a big deal. But if you're chasing yield, an example I use is when I got in on early, well, not early, but when I first started, and they're paying a 12% dividend. So every quarter they're going to open up 12% lower. And in my opinion, that's not sustainable. And actually, I think I might be wrong. 12%. But either way, they're paying a large dividend. Let's look at, they're paying a large dividend relative to their earnings. I could be wrong, but that's a bad idea. You want to avoid that. You don't want to blindly buy dividend stocks. So they have a fair value of $18 that I don't think is right, but maybe technically it is. Return on equity is negative. Dividends, they're doing 230%. 5-year average, 123%. So that means they're paying more than what they make. 123% more, well, of the total. So that's bad. That means they have to take on debt, and that means their market cap would technically be like even lower. So that's just some kind of ideas. There's when to buy and when to sell. This can kind of help. What should I look up? FedEx, for example. This is kind of hard to explain, but simple moving averages are good. It tells you when to buy and when to sell, basically. So if you look on the chart and sorry, it's hard to explain, but it basically helps. If it bounces off the 200-day moving average, then it's strong. I'm not going to try and explain it. I'm sorry. It takes time. So I think that's the video. We're getting a little long. I hope you guys enjoyed the new mic and some of the information I shared here today. If you have any questions, just leave a comment below, and thanks for watching. All right, bye-bye.